Michael Saylor just said something that no one in the Bitcoin world expected to hear. Selling Bitcoin to pay dividends. Yeah, you heard that right. The same man who built his entire reputation on never selling Bitcoin is now openly discussing a strategy where Bitcoin could actually be sold. And the crypto world? They're confused, divided, and honestly, some are panicking. Because if Saylor is even thinking about selling, what does that mean for everyone else? Now, before you jump to conclusions, this is where things get really interesting. Because this might not be what it looks like on the surface. In fact, this could either be the most dangerous shift in Bitcoin's strategy we've ever seen, or a genius-level move that most people completely misunderstand. But here's the thing that almost nobody is talking about. This isn't what it looks like on the surface. Not even close. Stay with me, because what I'm going to show you about where this is actually heading changes the entire picture. Not just for strategy, but for how Bitcoin itself gets absorbed into the global financial system. I'm your host on the Wealth Continuum, and if you're new here, welcome. We break down what's actually happening in markets, money, and wealth before it becomes obvious to everyone else. Hit subscribe now if you want to stay ahead, because this one is moving fast. A quick note before we go deeper. Nothing in this video is financial advice. This is analysis and education. Always do your own research. Always. Let's start at the beginning. Because to understand why this moment matters, you need to understand what Saylor actually built and what he just put at risk. Back in 2020, when MicroStrategy made its first Bitcoin purchase, the world thought it was a gimmick, a software company buying Bitcoin with company treasury funds. Analysts were confused, some were laughing. But Saylor wasn't joking, and he wasn't confused. He had a thesis, a precise, almost religious thesis. Bitcoin is the hardest form of money ever created. It will appreciate over time. The right strategy is to accumulate it, borrow against it, build capital structures around it, and never, ever sell it. That message never wavered. Not through crashes, not through regulation fears, not through crypto winters that wiped out entire ecosystems around him. He just kept buying, and the market rewarded him for it. By late 2024, MicroStrategy, renamed Strategy, had become the most talked about company in finance. Its stock hit $457. Bitcoin was near its peak. Saylor was on every stage, every podcast, every financial media outlet with one consistent message: never sell. So when he says on a live earnings call that he'll probably sell some Bitcoin to pay a dividend just to inoculate the market and send the message that we did it, you need to understand that this isn't just a tactical shift. This is a philosophical turning point, and those don't happen quietly. Now here's the part nobody's paying attention to. The word Saylor used wasn't sell. Well, it was, but the word that reveals everything is inoculate. Think about that choice carefully. Inoculate. Not generate cash, not service obligations, not manage liquidity. Inoculate. That's a medical term. You inoculate a body to prepare it for exposure to something it hasn't encountered before. You introduce a controlled dose of something, not to harm, but to train the system, to build immunity, to normalize a reaction. What Saylor is saying underneath the headline is this. He wants to prove to the market, and to Wall Street specifically, that Bitcoin can be sold in a controlled, strategic way without the sky falling. He wants to demonstrate that Bitcoin is a mature treasury asset, not a cult holding, not a diamond hands ideology, but a functioning financial instrument that can generate real cash flow when needed. That's a completely different message, and it opens a door that has never been opened before. Comment below. Does Saylor's inoculate framing make you more bullish or more cautious? I genuinely want to see where the community lands on this. But before we get too optimistic, let's talk about the pressure behind this move, because this isn't happening in a vacuum. There are numbers that explain exactly why Saylor is here right now saying this. Strategy currently holds 818,334 Bitcoin. As of the beginning of May 2026, that position was acquired at an average cost of approximately $75,537 per coin. That's an enormous stack. Nearly 4% of all the Bitcoin that will ever exist, sitting on one company's balance sheet. Now here's the problem. Bitcoin fell hard in the first quarter of this year, from roughly $87,000 on the 1st of January, all the way down to about $68,000 by the end of March. That's a 22% drawdown in 90 days. And because of new accounting rules that require companies to mark their digital assets to market, meaning they book the loss as it happens, Strategy had to report a $12.54 billion net loss for Q1 2026. $12.54 billion in one quarter. Now, that number is mostly unrealized. The Bitcoin isn't gone. It's still sitting there. But the accounting hit is real, and it sent ripples through the market. Meanwhile, Strategy is sitting on roughly $1.5 billion in annual obligations. dividends on two preferred stock instruments, STRK, which pays 8% annually, and STRC, which pays 11.5%. And here's the math that matters. Strategy has a USD reserve of about $2.25 billion, which gives them roughly 18 months of dividend coverage without touching a single Satoshi. So the selling isn't forced, the selling isn't desperate. That's exactly what Saylor wants you to understand. This is where things start to break down in the best possible way, because if you understand that point, you understand the entire strategy. Let me slow down here, because this is the part most people are glossing over. When Saylor says he will probably sell some Bitcoin, he's not describing a fire sale. He's describing a proof of concept. He compared Strategy to a real estate development company. His exact words, real estate development companies literally exist to buy land cheap and sell it expensively. We're like a Bitcoin development company. That reframe is massive. Think about what happens when you call a company a development company. You're saying, we acquire the asset at one price, we add value or wait for appreciation, and we sell strategically to create returns. That's not holding forever. That's active treasury management. And active treasury management is a language that Wall Street speaks fluently. Right now, major banks, Morgan Stanley, Goldman Sachs, Citi, are all rolling out Bitcoin-related products. ETFs, custody services, lending. The institutional infrastructure is being built in real time. What they need to fully embrace Bitcoin as an asset class is proof that it behaves like a real asset, that you can hold it, sell it, use it to fund obligations, and still maintain a coherent position. Saylor is giving them that proof. Hit like if this is starting to connect for you. Because the next layer of this is where the real opportunity and the real risk live side by side. Now let's talk about STRC, because STRC is the real engine driving all of this, and it's underreported. STRC is Strategy's variable rate preferred stock. It currently pays 11.5% annually. Since the start of 2026, Strategy has raised $5.58 billion through STRC alone, and more than $11.68 billion total across all capital raises year to date. Let me put that in context. STRC has financed the acquisition of roughly 77,000 Bitcoin in 2026. That's approximately 10 times the net inflow of all US spot Bitcoin ETFs combined over the same period. 10 times. While everyone was watching Bitcoin ETF flows as the signal for institutional adoption, the real institutional adoption was happening inside Strategy's capital stack. Quietly, systematically, without most people noticing. Now here's the tension that creates. Strategy is essentially saying, give us your yield-seeking capital, we'll put it to work buying Bitcoin, the Bitcoin will appreciate, and we'll use a combination of new capital raises, and now potentially, Bitcoin sales to service the dividend. That's a machine, a financial machine built around Bitcoin appreciation. But machines have a breaking point. If Bitcoin doesn't appreciate fast enough, or drops further, the gap between the paper value of the Bitcoin and the cash needed to service $1.5 billion in annual obligations becomes harder to bridge. What happens next is the real story, and I'll get to that in a moment. But first, morning, afternoon, or night for you right now, drop it in the comments. Always curious where the Wealth Continuum audience is tuning in from around the world. Let's talk about what this means for Bitcoin itself. Because this is where the conversation goes from Strategy's problem to everyone's problem, or opportunity. Strategy holds nearly 4% of the entire Bitcoin supply. For reference, there are only 21 million Bitcoin that will ever exist. Around 19.8 million have already been mined. Strategy has nearly 818,000 of them. That's not a small position. That's a systemic position. So when Saylor hints at selling, even small amounts, even strategically, the market hears something very specific. Supply might be coming. And supply is everything in Bitcoin. The entire bull thesis for Bitcoin rests on scarcity, on the idea that each halving reduces new supply, that long-term holders don't sell, that the float, the Bitcoin actually available on exchanges, keeps shrinking. That thesis is what created the historic moves we saw in 2023, 2024, shrinking supply, rising demand, explosive price action. Now introduce the possibility that one of the largest holders on Earth begins, even slightly, to sell. Does that change the calculus? Here's the honest answer. It depends entirely on what replaces it. And this is exactly why this matters right now, because Saylor is simultaneously doing something counterintuitive. By selling some Bitcoin and demonstrating it can be done strategically, he may be attracting an entirely new wave of capital that more than compensates. Think about pension funds, conservative endowments, family offices that have been on the sidelines because Bitcoin offered no yield, no cash flow, no way to fit into a traditional income-generating portfolio. If Bitcoin becomes the collateral behind a credible dividend-paying instrument, and that instrument is stable enough for traditional allocators, You've just unlocked a category of institutional demand that dwarfs anything we've seen so far. Saylor himself has pointed at the global credit market. $300 trillion. His thesis, the world's digital credit market is just beginning, and Strategy has built the first product to bridge Bitcoin collateral and traditional fixed income expectations. $300 trillion. The entire Bitcoin market cap at current prices is about $1.6 trillion. If even a fraction of that credit market capital rotates toward Bitcoin-backed instruments, what happens to Bitcoin's price? Are you positioned or just watching? Comment below. I want to know where you stand. Now let's stress test the other side, because it would be dishonest not to. There are serious critics of this model, and their concerns are not unreasonable. Some analysts, including people at Grayscale, have said that spot Bitcoin ETFs remain the cleanest, simplest way to get Bitcoin exposure. No leverage, no preferred stock complexity, no circular funding structures, just Bitcoin in a regulated wrapper. Others have gone further, calling Strategy's model circular. The criticism sounds like this. You issue preferred stock to raise cash, use that cash to buy Bitcoin. Bitcoin goes up and justifies the model. So you issue more preferred stock, buy more Bitcoin. And the whole thing works only as long as Bitcoin keeps going up. When Bitcoin went down 22% in Q1 2026, the model produced a $12.5 billion reported loss. The only reason it survived comfortably is because Strategy built a $2.25 billion USD cushion and has 18 months of runway. But 18 months isn't forever. And if Bitcoin spends the next 12 to 18 months grinding sideways or heading lower, the pressure to sell Bitcoin for real operational cash becomes significantly less strategic and significantly more necessary. That's the scenario that keeps critics up at night, not the controlled signal-sending sale Saylor described, the forced sale, the one where you're not choosing the timing. Now, to be fair, Strategy has been here before. They survived the 2022 crypto winter when Bitcoin fell below $17,000. They didn't crack then. And they have far more structural support now than they did in 2022. But the risk is real, and you should hold both truths at once. Share this with someone who holds Bitcoin or MSTR, because understanding both sides of this is exactly the difference between being early and being wrong. Let me zoom out now, because the biggest story here isn't Strategy or STRC or even Saylor personally. The biggest story is that Bitcoin is entering a new phase, and that phase has a name. It's called financialization. Every major asset class in history has gone through this cycle. Gold went through it. Real estate went through it. Corporate bonds, commodities. First, an asset is misunderstood, treated as speculative, fringe, or ideological. Then it's adopted, slowly, by a few pioneers who take the asymmetric bet. Then it's financialized. It becomes the raw material for structured products, derivatives, income instruments, and capital market machinery. Bitcoin is entering phase 3 right now. You can see it everywhere. Spot ETFs, institutional custody, bank-issued Bitcoin lending products. And now, a publicly traded company signaling that it will sell Bitcoin as part of a deliberate treasury management strategy. These aren't separate events. They're the same event, playing out across different arenas simultaneously. And here's why financialization changes everything. When an asset gets financialized, demand doesn't just increase gradually, it inflects. Because you're not just adding new buyers who want the underlying asset, you're adding an entirely new layer of buyers who want the instruments built on top of the asset. Bonds aren't just for people who want to lend money, they're for pension funds, insurance companies, sovereign wealth funds, entities that are required by mandate to hold fixed income instruments. If Bitcoin-backed instruments, like STRC, start qualifying for those mandates, the demand picture transforms completely. That's the bull case that Saylor is building toward. Not next quarter, not even next year, but over the next decade. Subscribe if you want to stay ahead of what's coming, because this conversation is only going to get louder. Now, let me walk you through the 3 most realistic paths forward, because where this goes from here is genuinely uncertain, and the range of outcomes is wide. Path 1. Bitcoin recovers strongly and the model validates itself. If Bitcoin climbs back toward and beyond its previous highs, Strategy's position moves back into significant profit. The BTC yield metric, which was 9.4% year-to-date as of Q1, continues to grow. New capital floods into STRC and similar instruments. The never sell stigma fades as it becomes clear the machine is working. Institutions pile in. Saylor's thesis becomes consensus. In this path, the symbolic sale he described, selling a small amount of Bitcoin to pay one dividend cycle, becomes a footnote. A signal sent, received, and forgotten. And Bitcoin's price is driven higher by the very institutional demand that Strategy helped unlock. Path 2, the model comes under real pressure. Bitcoin stays range-bound or continues to decline. The $12.5 billion Q1 loss is followed by more losses. The USD reserve gets drawn down. The gap between paper Bitcoin wealth and real cash obligations widens. Strategy is forced to sell more Bitcoin, not symbolically, but substantively. In this path, every sale becomes news. Every sale signals to the market that the supply dam is broken. Other large holders watch. Other treasury companies reconsider. Selling begets more selling, and the supply shock thesis, the engine of every Bitcoin bull run, weakens. Path 3. Saylor's inoculation actually works. This is the most nuanced path, and I think it's underrated. What if by selling just a little Bitcoin, cleanly, publicly, intentionally, Saylor removes the psychological barrier that has been keeping a certain class of investors out? Right now, there's a category of investors who won't touch Bitcoin-backed instruments precisely because they don't believe you can ever actually realize the value. They look at Strategy's Bitcoin stack and say, that's great on paper, but what happens when you actually need cash? If Saylor answers that question definitively, sells, pays a dividend, price holds, world doesn't end, he removes one of the last major objections from yield-seeking institutional capital. And if that capital flows in, at scale, Path 3 looks a lot like Path 1, except with even deeper, more structural demand underneath it. Now, what would you do if Path 3 actually plays out? Comment below. I want to know how you're thinking about positioning. Here's what I want you to take away from all of this. Markets don't just move on data, they move on narratives. And the most powerful market narratives are the ones that shift the frame, the ones that change the question from should I hold this to how do I hold this? For 4 years, Saylor's narrative was hold Bitcoin forever, never sell. The strategy is so simple it sounds like stubbornness. But that narrative, while powerful, had a ceiling. You can only attract investors who share the ideology. Everyone else, the yield seekers, the income allocators, the conservative capital, stays on the sidelines. Now Saylor is trying to change the frame from hold forever to Bitcoin as the foundation of a new kind of financial system, from ideology to infrastructure. That's a much bigger tent. And the moment a much bigger tent opens, the moment Bitcoin stops being a belief system and becomes an asset class with all the financial machinery that entails, the demand characteristics change at a fundamental level. Now, does that make Bitcoin better or worse? That's the question worth sitting with. Some would argue financialization dilutes what made Bitcoin special. The whole point was that it existed outside the system, that it couldn't be controlled, packaged, or structured, that it was incorruptible. The moment Bitcoin becomes just another instrument, another lever that Wall Street can pull, does it lose its soul, or does it become unstoppable? Does it become so deeply embedded in the global financial architecture that no government, no regulator, no market downturn can ever fully dislodge it? Both outcomes are possible. And which one materializes depends on choices being made right now by Saylor, by institutional allocators, by regulators, and by the millions of people who hold Bitcoin and get to decide day by day whether they are participants in a financial revolution or customers of a new kind of financial product. Do you think the system can hold? Drop your honest take in the comments. No wrong answers here. This is exactly the conversation we need to be having. Let me give you the bottom line. Michael Saylor did not crack. He did not abandon Bitcoin. He did not signal distress. What he did was something far more interesting and far more deliberate. He introduced a new chapter in the Bitcoin story, one where Bitcoin isn't just something you hold and prey on, it's something you build with, something you engineer financial structures around, something you use strategically to generate real-world returns while maintaining long-term exposure. Whether that chapter ends in triumph or in complication depends on variables that nobody, including Saylor, can fully control. Bitcoin's price trajectory, the pace of institutional adoption, the regulatory environment, the behavior of other large holders, the appetite of yield-seeking capital for instruments like STRC. All of those are moving in real time, and the outcome is genuinely open. But here's what's not open. This moment, this week, is the moment the Bitcoin narrative shifted from holding to using, from ideology to infrastructure, from a bet on digital scarcity to a bet on digital financial engineering. And the people who understand that shift early, who see what's actually happening beneath the headline, are the ones who position themselves correctly for what comes next. Everyone else will figure it out later. Subscribe to the Wealth Continuum if you want to be in the first group. Because the next shift isn't months away. It might already be starting. And when it moves, it's going to move fast.